Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three of the biggest companies in the world ahead of their upcoming earnings releases later in the week to see if any of them are worth buying, and that is Microsoft, Apple, and Amazon. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into Microsoft and Apple and Amazon, I want to quickly just take a somewhat broader look about the market and then the overall earnings picture to give more context for these three big heavyweights of the tech space and the market in general. So the market we saw pulled back sharply in early afternoon trading last Thursday on reports that the Biden administration was considering roughly doubling the capital gains taxes on the wealthy. The news, which hardly means any real action will be taken, sent the Dow, the S&P 500, and the NASDAQ all down about 1% during regular hours last Thursday. But then stocks popped on Friday and were up Monday morning ahead of a big week for corporate earnings. So with that said, the strong fundamental backdrop seems to remain fairly well in place, especially with the Q1 earnings results so far coming in very strong, and a lot of strong guidance coming from everyone from Wall Street titans to other firms throughout different sectors. And all of this is being spurred along by vaccine rollout positivity, and there could be a U.S. economy that sees 6.5% U.S. GDP growth in 2021, which would be the best in well over 30 years. And atop of all of this, the continued injection of what could be more trillions of dollars into the economy in those ultra low interest rates are going to further stoke that economic resurgence. So with this in mind, Zacks estimates are now calling for Q1 results for the S&P 500 earnings to be up 30.2% on 6.6 higher revenue. So this comes against that easier to compare first quarter of last year that marked the very start of the coronavirus, and then obviously Q2 is going to be the comparisons against that very easy to compare period last year. So we're calling for nearly 54% earnings growth next quarter. But the earnings estimates continue to go up with those strong results that have come in for Q1 so far. So with this in mind, we're going to start to look at the tech space specifically in terms of earnings. So heading into this 2021, tech stocks had been on a rapid pace off those bottoms of last year. But in 2021, things have changed a little bit, and some of the big tech players that had been leaders, especially from this FANG space, have kind of recalibrated. So Google had been a little bit of a laggard, and now Google, of the five FANG stocks, is up about 31% this year. Microsoft, which is not a FANG stock, but it's part of that big group, is the second biggest leader, and it's outpacing that tech space and the broader S&P 500. But we see Amazon and Apple as the big laggards so far of this group. Apple's up just about 1% this year, and Amazon's up about 4% overall in 2021. So we'll see if these earnings results from these two big companies will be able to change any of their trajectory so far. And then if we look at technology specifically for overall Q1 earnings, we're calling for about 25% earnings growth on about 18.5% revenue growth. So the earnings would be a little bit lower than the overall S&P 500, but on much stronger revenue growth for the broader technology sector in terms of what we're expecting for Q1. So with this as the backdrop, we're going to go ahead and take a look at the first of the three big companies that are set to report their quarterly results this week. And obviously there are countless other companies that are set to report. We're focusing on these three tech giants this week. So Microsoft, which trades under the ticker MSFT, is the first of these three companies set to report. They report their Q3 fiscal 2021 results after the closing bell on Tuesday, April 27th. So Tuesday of this week. And now we're just going to jump right into Microsoft. So Microsoft has surged over 11% since the end of March to hit new records. This included Monday morning hitting new 52-week highs. But we'll get into the climb a little bit down the road. So let's first dive into Microsoft's growing portfolio. So the company announced on April 12th that it agreed to buy Nuance communications for about $16 billion, which would make it its second largest deal ever under its current CEO. Microsoft paid $26 billion for LinkedIn back in 2016. So Nuance is at the forefront of speech recognition and AI technology in both customers in finance and other fields. Its offerings have also become really popular in the healthcare world, where more doctors want to dictate patient notes digitally and do far more with artificial intelligence and other things like that. So Nuance's speech recognition and tech will be rolled into Microsoft's booming cloud business for healthcare clients and beyond. The deal helps Microsoft further challenge other speech recognition players and help the business grow as it races to just become more diversified going forward. So the ability to make these strategic acquisitions, big and small, has helped the historic tech company diversify and go on a spree that includes big names and small companies alike. So Microsoft's ability to expand its cloud business alongside Amazon and others during the last several years has also transformed the tech icon's outlook into a much more stable growth play, even at the moment this far into the company's life cycle. So cloud now plays a role across the entire company. This is from Office to Xbox to remote work products and beyond. So the company's commercial cloud revenue climbed 34% last quarter to account for about 40% of total sales. So looking ahead, Zach's estimates are calling for Microsoft's adjusted Q3 earnings to climb about 26% on 17% higher revenues. More broadly, its fiscal year revenue is projected to jump about 14% to $164 billion, with FY 2022 set to pop another 10.5%. So this would extend its streak of between 10 to 15% sales growth to 5 years for Microsoft, which is rather impressive for a company that went public in the mid-1980s. Meanwhile, its adjusted earnings are projected to climb 28% and 10% respectively over this 2-year stretch. And Microsoft's earnings revisions have turned more positive recently to help it grab a Zacks ranked number 2 buy heading into its earnings release. And we should note that 20 of the 22 brokerage recommendations that Zacks has for Microsoft are also strong buys. And as we talked about earlier, with all these acquisitions, Microsoft finished last quarter with $132 billion in cash and equivalents in the stockpile, as how it's been able to fund these acquisitions as well as buybacks. We should note that last quarter, the company returned $10 billion to shareholders via repurchases and dividends, which is up 18% from the year ago period. And its dividend yield is currently sitting at about 0.85%. So as we touched on at the top, Microsoft has surged to new highs throughout April, and this includes another new record Monday. It hit $262.42 as of Monday morning, which is brand new all-time high. So this run has helped end a relative period of stagnation, with the company up about 50% in the last year to lag the overall tech space. But as you said, the last month or so has been very strong for Microsoft. Also, the stock has more than doubled the industry over the last 5 years. So it's been on a really impressive 5-year stretch. It's up about 360%. With that said, it does trade at a premium to its industry, but Wall Street is clearly willing to pay up for Microsoft. The recent push has stretched the stock in terms of those RSI levels, but at 65, it's sitting below that overbought level that's 70. So there could be some more room for growth. That said, there could clearly be a pullback even if Microsoft is able to provide strong guidance and post impressive results, because as we said, the stock has run up to new highs throughout the month so far. So there could clearly be a pullback given that Microsoft stock has run up so high in the lead up to earnings. With that said, if you're a longer term investor, you don't necessarily need to worry about trying to time Microsoft stock exactly, as if you have a year or longer horizon, it's likely the stock will be higher than it is today a year from now, given its growth outlook and just how important the company continues to be in key growth industries throughout tech. So with this in mind, we're now going to jump into another massive technology company that reports later in the week, and that is Apple, which trades on the ticker AAPL. And they are set to release their Q2 FY21 results on Wednesday, April 28th. So Wednesday after the bell. We have Microsoft on Tuesday, and Apple is then on Wednesday. So Apple is a $2.2 trillion market cap giant, the biggest company in the world. It's outpacing the number two, Microsoft, which is right around that $2 trillion threshold. So like its peer, Apple has been on a nice run since the end of March as well. Yet where it's sitting, its stock still trades about 8% below its January records, which could give it a bit more runway as we make a move into earnings and beyond that. So with this in mind, Apple has soared about 90% in the past year, so well ahead of Microsoft. As we mentioned, it was up huge off those March lows of 2020, but it has cooled off in 2021 besides for its recent climb. So this all comes on the back of its stability, its loads of cash, that 4-for-1 stock split, and that growth outlook was why it was so strong in those early coronavirus days. We should also note that the company closed last quarter with $84 billion in net cash, and it plans to keep buying back stock and paying dividends as its executives try to reach what they call a cash neutral position over time, which will be very hard when you consider how much cash they have, but that's great news for investors. So Apple's dividends yielding about 0.6% at the moment, which does fall well below those treasury yields, even the 10-year yield. But let's remember that the stock has skyrocketed about 400% in the past 5 years, versus the tech sector's 175% climb, in the benchmark index is 110%. So Apple's up 400% in the last 5 years. So that dividend is not mattering as much, that it's a little less, and it's hard to have a strong dividend yield when your stock's up 400% in 5 years. So the stock is also trading below its year-long medians in terms of both forward earnings and sales. And Apple earns a Zacks rank number 3 hold right now, alongside an A grade for growth and a B for momentum in our style score system. And if we look back, Apple posted 21% revenue growth last quarter, topping our revenue estimate by nearly 10%. And this was driven by nice sales from that first 5G iPhone, that iPhone 12. It's that first 5G capable smartphone for Apple. iPhone revenue popped 17% last quarter to account for about 60% of total sales. So even though they are diversifying beyond the iPhone, when the iPhone does have a new release, that phone often accounts for a large chunk of their overall sales. That said, it wasn't just the iPhone that did well last quarter. iPad and Mac sales were up 42% and 23% respectively, with that Apple Watch and AirPods heavy wearables unit up about 30%. And Wall Street's also remained pretty focused on CEO Tim Cook's mission to continually make money from its massive and growing user base. So its services efforts go far beyond the App Store. This includes Netflix and Spotify competitors, as well as subscription news offerings, a video game platform, digital workout classes, and much more. So the company ended last quarter with 620 million paid subscriptions, up 140 million from the year ago period. Along with these subscription efforts, the firm is trying to bring more of its chips in-house, and there's even reports that Apple is considering entering the electric vehicle space. So like with Microsoft, this big, huge tech giant is doing all they can to diversify their business, especially with these subscriptions, just to have more consistent revenue streams as well. So Apple also has pushed its privacy efforts more recently. This move impacts Facebook and others, and you might see more of this from Apple, especially as privacy concerns become more of a big issue with consumers and governments alike. So looking ahead, Zacks estimates are calling for Apple's second quarter revenue to surge 33% to help lift its adjusted earnings by 55%. Once again, this is coming against a relatively easier to compare period in the year ago period. Overall, its 2021 earnings are expected to climb 37%, with its sales expected to jump 23% all the way to $337 billion. This would be its strongest growth since 2015. The company is then expected to keep growing next year, and it's topped our earnings per share estimates by an average of about 20% in the trailing 4 quarters. Like I mentioned with Microsoft, with all stocks playing Apple for those near-term gains around earnings is risky if you're trying to, as I said, make those near-term plays. But investors aiming to hold the world's largest company for years to come might want to consider buying Apple at an 8% discount heading into earnings, especially as the market is continuing to break new records so far in 2021. And now we're going to transition on to the last company that we're talking about this week, and that is Amazon, which trades under the ticker AMZN, and they report their Q1 FY21 financial results after the closing bell on Thursday, April 29th. So Microsoft's first on Tuesday, Apple Wednesday, and then Amazon is the last company of these three on Thursday afternoon. So Amazon has been in the news a decent amount recently. It's come under attack from various groups and both sides of the political aisle. This could be a continued theme for Amazon going forward, but that's kind of what happens when you become one of the world's largest private employers and one of the largest employers in the US. And Amazon has come under scrutiny in Washington for some of its practices, including how it treats retailers and third-party sellers on its platform, which it controls. I encourage anyone who's interested to read some of the longer stories about this. But with that said, Amazon CEO Jeff Bezos, who is transitioning out of the role, has pointed out that other retailers, including the likes of Target, also sell their own products that compete against other brands. That's kind of just how the business works. More importantly, the company is sure to fight back against any real legal action that might be taken. With that said, the stock has also popped 10% since the end of March, as Wall Street continues to show that they're going to shrug off any of these worries. The Seattle giant was also built for the coronavirus environment, and it's ready to thrive for years to come as it grows more market share in retail and beyond. So the company's AWS cloud computing unit was already booming before the pandemic, spurred businesses to speed up their digitalization efforts and remote capabilities. The company is also now the third largest digital advertising player behind only Google and Facebook. Amazon is also expanding its brick and mortar efforts, given that e-commerce still accounts for only a small portion of total retail sales. Overall, it's about 16% of total retail sales. So the company is expanding as many brick and mortar options as well. The company also continues to make money from its Prime heavy subscription unit, and it also aims to compete, like a lot of these big tech companies, in the streaming world as well. So they have Amazon Prime Video that competes against Netflix. They have their own music service that competes against Spotify and others. So with this in mind, Amazon sales climbed 38% last year to $386 billion for its strongest top line growth since 2011. So they grew 38% last year, and in 2011, they grew 40%. So that was their best growth in nearly a decade. Zacks estimates now call for its first quarter revenue to jump over 39% to help lift its adjusted earnings by 99%. Overall, Amazon's FY21 sales are expected to jump another 23% or $87 billion higher to reach $473 billion to help lift its adjusted earnings by 18%. The company's adjusted FY 2022 earnings are then expected to climb another 38% on 18% better sales. So this company just continues to grow by nearly $80+ billion a year, which is very, very impressive. And Amazon has crushed our bottom line estimates in the trailing 3 quarters, and its consensus earnings estimates have popped recently. Amazon currently is landing a Zacks rank number 3 hold at the moment, alongside an A grade for growth. With that said, 30 of the 34 brokerage recommendations Zacks has for Amazon are strong buys, with the rest at a buy. The company also landed number 3 in terms of financial strength in last year's management top 500 rankings, behind only, as you might have guessed, Apple and Microsoft. So these are the 3 biggest tech companies in the world, and also some of the 3 most financially sound companies as well. So Amazon stock has popped about 40% in the last year, as I mentioned, to lag behind other tech names, but the stock has gone on a bit of a run recently, and it's still trading about 5% below its 52-week highs. And the stock is also not overbought in terms of RSI, so it could have even more room to grow as we head into the earnings release and after that. And at the moment, it's trading at about 3.4 times forward 12-month sales, which is below its own median and at a discount compared to its industry, and well below both Apple and Microsoft. So it's trading at 3.4 times sales. Apple's trading at 6.4 times forward sales, and Microsoft is trading at 10.9 times forward sales. So, even though its actual stock price is much more expensive than Amazon in terms of those valuation metrics and forward sales, Amazon is looking pretty strong. So with all of these stocks, near term is more unknown, but investors with longer term horizons, it's not unique to say that these three stocks might be worth adding to your portfolios as stable, huge growth tech stocks. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.